What if I told you that one of the smallest, most volatile resource markets is on the cusp of a multi-year bull run with massive asymmetric upside potential? It's a market that's only recently featured on investors' radars and will continue becoming increasingly vital to global energy security. Today, of course, we're diving into the world of uranium. As countries worldwide turn back to nuclear energy, uranium is emerging as the silent powerhouse in the push for reliable, low-emission energy. But with a severe supply deficit and tight market conditions, uranium is poised for a violent repricing. We'll explore why this market has remained so undervalued, what's driving demand, and how investors can position themselves to capitalize on what we think will be the coming uranium bull run. This video is produced by the team at Capitalist Exploits. Headed by professional asset managers Chris McIntosh and Brad McFadden, the team hunts for deep value assets that are surprisingly contrarian despite strong fundamental cases for potential future appreciation. If you're looking to gain access and insight as to the personal investments of active hedge fund managers and in-depth reasoning as to why they've invested in the assets they're sharing, check the links in the description below. You'll get access to advice on how to allocate, organize, and think about your portfolio while joining a growing community of people thinking outside of the box. Enjoy monthly updates, open Q&As, regular newsletters, a community forum, organized portfolios, investing education videos, and more with the Capitalist Exploits Insider subscription. If you're not ready to fully take the leap, we also offer the Capitalist Exploits Insider newsletter series for $1 for the first 30 days and $35 a month thereafter. Do note, our investing strategy and philosophy can deviate a lot from the mainstream. We offer a money-back guarantee regardless, but make sure you're on board with our investing philosophy and global outlook before deciding to join us. The uranium market is a classic example of supply and demand asymmetry, where demand continues to grow but supply lags far behind. Nuclear reactors operate year-round, meaning uranium demand is highly inelastic. Utilities need it regardless of the price. Yet, uranium supply has been declining for years, creating a gap that's only getting wider. For over a decade, uranium prices were too low for miners to stay profitable, leading to production cuts and capacity closures. Industry giants like Cameco and Kazatomprom shut down or scaled back operations at major sites, leading to a dramatic drop in global uranium production. Now, with supply already at record lows, even a modest uptick in demand could trigger substantial price spikes. And then there's the geopolitical side. Over 40% of the world's uranium comes from politically sensitive regions, including Kazakhstan and Russia. With tensions flaring between Russia and the West, countries are actively looking to reduce their dependence on Russian uranium, further tightening the market. The US alone relies on imports for the vast majority of its uranium needs, adding urgency for stable alternative resources. But while supply remains constrained, demand for uranium is set to soar as countries turn to nuclear energy for reliable, low-emission power. As nations face a growing energy crisis, nuclear power is increasingly being recognized as the solution. Governments are looking to cut carbon emissions while ensuring energy security, and nuclear checks both boxes. In Asia, we're seeing a rapid expansion in nuclear infrastructure. China and India are at the forefront, with China planning to build dozens of new reactors and India following suit with ambitious nuclear goals. Even Japan, once hesitant after the Fukushima incidents, is now reactivating reactors to secure stable, clean energy. This global expansion is a strong signal for uranium demand, and that demand is likely to continue rising as nuclear power becomes central to energy policies worldwide. Nuclear power is a low-emission, high-reliability source of baseload energy, something renewables like solar and wind can't consistently provide. As fossil fuels become more politically challenging, nuclear is emerging as the practical alternative. Nuclear energy provides reliable, on-demand power without the emissions of coal or natural gas, making it critical for Western countries with misguided net zero goals. And it's not just rhetoric. In recent years, governments in Europe and North America have begun to support nuclear energy as part of their long-term energy strategies, including direct investments and policy incentives. This policy support is creating a favorable environment for uranium producers and establishing a long-term growth trajectory for nuclear power. But to truly grasp the uranium bull case, we need to understand why this isn't just a temporary rally. It's the beginning of a long-term bull market built on years of underinvestment. So here's where things get pretty interesting. Uranium's structural supply deficit and a prolonged lack of investment are setting up for a sustained bull market. Unlike other commodities, uranium production can't just be ramped up overnight. The uranium mining industry faces significant lead times and requires heavy capital investment. On average, it takes 7 to 10 years to bring a new uranium mine online, from exploration to production. This long timeline creates a natural lag in supply response, which means that even if prices surge, new supply won't hit the market quickly. As demand grows and supply remains constrained, this dynamic will likely keep prices elevated for years. The market has also suffered from severe underinvestment. Years of low prices discouraged new projects, leaving the industry with limited capacity to respond to sudden demand increases. Many mines remain undeveloped, and those in production are operating below full capacity due to years of neglect and lack of funding. With so few resources coming online, the market remains vulnerable to supply shocks, which are likely to drive prices even higher. To top it off, nuclear utilities, the main buyers of uranium, have been holding off on long-term contract renewals, hoping for lower prices. But as the supply deficit becomes apparent, these utilities will be forced to lock in contracts, likely at much higher prices. This contract renewal cycle is a strong catalyst for uranium prices as utilities scramble to secure limited supply. But it's not just market fundamentals at play here. Geopolitical factors are adding even more pressure on the uranium supply chain. Uranium isn't just another commodity, it's a strategic resource for national security. As global geopolitical tensions rise, particularly between the US and Russia, uranium is taking on newfound importance. Russia and Kazakhstan dominate global uranium production, with Russia also playing a significant role in the uranium enrichment market. With Western nations wary of relying on Russian or Kazakh uranium, there's an urgent push for alternative sources. The US, for instance, has been evaluating policies to reduce dependence on foreign uranium, potentially mandating a portion of its uranium to come from domestic producers. This move would support US-based uranium companies while further straining global supply. Then, there's resource nationalism. Countries with uranium reserves are increasingly considering prioritizing their own needs over exports, a trend that could disrupt global supply chains. This could mean export controls or increased taxation on uranium exports, which would only heighten the scarcity in the market. So we know now that uranium isn't just a short-term play. It's a contrarian long-term investment that requires patience. For those willing to endure some volatility, uranium presents an asymmetric trade opportunity where the potential upside far outweighs the downside. Right now, uranium prices remain relatively low, creating an attractive entry point. While uranium may experience price fluctuations, the secular trends driving demand are clear and likely to continue over the long term. Investors who build positions at these levels could be well positioned to benefit as the supply-demand imbalance becomes more pronounced. And the uranium sector is largely underrepresented in institutional portfolios due to its small market size and inherent volatility. But as institutional investors begin to recognize uranium's strategic importance and potential for outsized gains, we're likely to see a re-rating of uranium equities. Increased capital inflows will push valuations higher, potentially creating substantial price appreciation for early investors. This is where asymmetric risk-reward comes in. Uranium's relatively low production costs, paired with soaring demand, mean that even a small capital exposure could yield significant returns if the market conditions play out as expected. But how do investors actually get exposure to uranium's potential? Let's look at the two main ways: uranium miners and physical uranium holdings. Both of these have unique benefits and can be combined for a balanced, leveraged investment approach. First, let's talk about the miners. Companies like Cameco, Denison Mines, and Energy Fuels provide high leverage exposure to uranium prices. When uranium prices increase, these miners see not only higher revenues, but also greater profit margins, amplifying gains. However, investing in miners can be volatile, as these stocks tend to fluctuate with uranium price changes and the operational risks of mining. Selecting financially stable companies with strong production potential is key to maximizing returns here. Alternatively, there's investing in physical uranium. Vehicles like the Sprott Physical Uranium Trust allow investors to gain direct exposure to uranium prices without the operational risks associated with mining. By holding physical uranium, investors can participate in price increases in a more stable way, making this an ideal option for those looking to avoid the volatility of mining stocks. So to wrap everything up, we think the uranium market offers a unique, high-reward opportunity that's driven by a blend of structural supply constraints, growing global demand, and strategic importance in the energy sector. For those willing to look past short-term price swings, uranium presents an asymmetric trade that could provide significant returns as the market rebalances. Don't forget that uranium is one of the many themes or portfolios that we have organized in the Capitalist Exploits Insider Members section. To gain access to the specific companies we're looking at, and even more in-depth rationale about the uranium industry and many other sectors, check out the links in the description below. The research used in this video is also available in the description below, and thank you so much for watching, and remember to stay informed.